Ladies and gentlemen, it just happened. Credit card losses are rising at their fastest pace since the great financial crisis. And this couldn't happen at a worst possible time because another interesting fact, credit card debt in the US just surpassed $1 trillion for the first time. But what you're probably wanting to know is, okay, that sounds pretty bad, but what does it actually mean for the economy, markets, banks, you and me? Well, that's exactly what we're going to discuss in today's video because this will have major implications for us all. This is going to lead to a huge recession, job losses, market volatility, and possible bank failures. Also, at the end of the video, for anyone that's in this terrible situation, I'll give you some real practical tips on how you can get out of it. So everyone, without further ado, let's get straight into the news, the facts, and the data. Wow, look at this, everyone. Again, like I said, it is happening and it's far worse than expected. This is not clickbait. Credit card losses are rising at their fastest pace since the great financial crisis. But again, how exactly is this happening and what implications is this going to be for you, me, the economy, and the markets? Let's keep reading. Well, I'll go ahead and bring up a chart here. Credit card losses bottomed in September 2021, and while initial increases were likely reversals from stimulus, again, we saw all the stimulus that went out there, people used that to pay off their credit card debt, they have been rapidly rising since the first quarter of 2022. So again, like we need to see in this chart here, you need to look at the trend reversal, and right now we're seeing a massive trend reversal that will surpass the 2008 financial crisis. Now, since that time, it's an increasing rate of losses only seen in recent history during the recession of 2008. And guess what, people? This firm predicts this is only beginning and is about to get far worse. Losses currently stand at 3.63%. That is up 1.5 percentage points from the bottom, and Goldman sees them rising another 1.3 percentage points to 4.93%. But everyone, what can happen with these delinquencies? This can lead to domino effects. More and more people become delinquent. That leads to people spending less. That leads to more and more layoffs. That leads to more and more people losing their jobs. And we see delinquencies rise out of control. But again, their prediction is we think delinquencies could continue to underperform seasonality through the middle of next year and don't see losses peaking until late 2024 and early 2025 for most issuers. Now, I completely agree. I've been warning about how we won't see real economic pain until 6 to 12 months after interest rates hit their peak. And now with the latest inflation reports, now with a lot of speculation that the Federal Reserve is not done lifting interest rates, we haven't even felt the full impacts of this economic pain that will be coming. Yes, while things are bad now, people, it will get far worse. And like he sees, and we'll go over it in a moment, when you look at history, we haven't hit peak pain in the credit cycle yet. And I find this quite hilarious, everyone. They say, what is unusual is that losses are accelerating outside of an economic downturn. Well, I don't know about you, everyone, but I think it's quite obvious we are in a severe economic downturn. But what they do is they put out these statistics and then they massively revise them quietly 1 to 2 months later. But when you go out there in the real world, you speak to real Americans, the real middle class on how things are getting harder. You listen to songs like Rich Man North of Richmond. You see the sentiment out there in society. People are really struggling and things are getting worse. But a lot of these big bankers are completely out of touch with the average American and they just see themselves getting big bonuses and they don't know what's really going on out there. And like with all these economic data points, these are always looking in the rear view mirror. That's why you have to go out there in the real world and get real data points, real data sets to see what's really happening. But listen to this. This is very interesting, everyone. Of the past 5 credit card loss cycles, there were 3 categorized by recessions, he said. The 2 that occurred when the economy was not in a recession were in the mid-90s and 2015 to 2019. So go ahead and bring up a chart here. We can see that in 2015 and 2019, credit card delinquencies were rising, but then they printed huge amounts of stimulus in 2020 and 2021. And even though we did have a recession, we would have naturally had a recession if they didn't go ahead and pump all that stimulus out there in the economy. Now, like I always talk about, the best way to predict the future is to look at history. So he says, in his view, this cycle resembles the characteristics of what was experienced in the late 1990s and somewhat similar to the 2015 to 2019 cycle. Well, I think it's going to be much worse than that, everyone. everyone, where losses increased following a period of strong loan growth and had seen similar pace of normalization thus far this cycle. History also shows that losses tend to peak 6 to 8 quarters after loan growth peaks. So again, people, like I talked about, we're just at the beginning of this huge economic downturn that will be coming, so you need to prepare right now, and I'll tell you how at the end of the video. That implies that the credit normalization cycle is only at its halfway point, hence the late 2024 and early 2025 prediction. So what do you think, everyone? Do you think we're going to see peak pain in 2024, 2025? Let me know in the comments below. But everyone, that's just the beginning. I have so much more very, very huge facts and data to show you that things are getting very, very bad with credit card debt. This is going to lead to a huge economic pain and also big trouble for the banks. Okay, so first things first, let's have a look at what states actually have the most credit card debt. We can see here, Connecticut, they actually have the most average credit card debt of $9,400, followed by New York, $9,100, New Jersey, $9,000, Rhode Island, $8,700, Texas, $8,700, and Florida, $8,500. But what states actually have the lowest average credit card debt? Well, that's Kentucky at $5,400, Indiana, $5,600, West Virginia at $6,000, followed by Mississippi and Idaho. Now, the latest data, the average credit card balance in the US was $7,279. So exactly how do you compare to the average American? I hope you're doing a lot better than them. Now, also a great report, how many Americans carry a balance? Well, we can see here 43% of Americans carried a balance at some point, 34% use a card but never carried a balance, and 23% had a card but didn't actually use it. Now, a big reason I think we're seeing delinquencies rise is because interest rates are soaring. And people, I don't use a credit card, so when I saw what kind of interest costs people are paying, this absolutely blew my mind. You should not be paying these crazy interest rates, people. Don't even start thinking about investing in the markets until you pay off these credit cards. Because look at this, everyone. The average APR for new credit card offers was 24.45%. That is absolutely crazy, okay? Go ahead and pay it off as fast as you can. Now, this is another great chart here. We can see the average interest rates on new credit card offers in the US by category, by industry. We can see the minimum was around 21%, the maximum 27%, which is absolutely crazy. And we can see here airline credit cards have some of the highest interest costs of 29.33%. But people, what you need to know is the stock market isn't always fully correlated with what happens in the economy and what happens in the debt markets. And during every single crisis, there is always massive opportunity. And that's why I want to talk about today's video sponsor, Shapeways, and the massive opportunity it presents. Now, that's stock ticker SHPW. Now, again, people, this is an opportunity to be part of a revolutionary transformation in the world of manufacturing. They are providing on-demand and scaled manufacturing services powered by proprietary software, making complex manufacturing simple. This is a company driven by innovation and a commitment to changing the status quo. Now, what are the big takeaways on why this is such a big opportunity? While they're reshaping the multi-trillion-dollar global manufacturing market, Shapeways is at the forefront of digitalizing the entire manufacturing process. They are disrupting a multi-trillion-dollar market that has traditionally been slow, manual, and rigid. Second, they have proven quality and global reach. Shapeways has already delivered over 24 million unique parts to more than 1 million end customers in 180 countries. And their commitment to quality and reach is unparalleled. Third, they have strong enterprise growth. The company's growth in enterprise manufacturing is impressive and comes with attractive economics. Shapeways is well positioned to meet the needs of a diverse customer base. Now, fourth, they have cutting-edge digital manufacturing software. Shapeways offers a differential digital manufacturing software platform that enables other manufacturers to digitalize their operations, and this opens a world of opportunity for growth. Fifth, their path to profitability. Now, Shapeways is on a clear path to profitability. With accelerating software adoption and a scaling of enterprise manufacturing solutions, they are poised for success. Six, they have experienced management team and investor support. Shapeways is led by an experienced and highly invested management team. They have garnered support from blue chip venture capital funds like Andreessen, Horowitz, Lux Capital, Union Square Ventures, and INKEF. But that's not all. There's another compelling reason why Shapeways is such an amazing opportunity. The CEO has a strong commitment to the company by buying shares during the last 3 window openings. This level of confidence from the leadership team speaks volumes about the company's potential. So as we look ahead, Shapeways has a tremendous opportunity to disrupt the manufacturing landscape. The global manufacturing market is valued at over $2 trillion, and Shapeways is well positioned to capture a significant share of this market with its digital transformation approach. Furthermore, Shapeways is actively scaling its growth initiatives, which includes software tools and services that are experiencing exponential growth in bookings. They're focused on improving gross profit, reducing operation expenses, and conserving cash balances reflects a prudent approach to financial management. But ladies and gentlemen, that's not all. We also got a very, very bullish announcement that's just been put out by Shapeways. So Shapeways strengthens position in its multi-million-dollar automotive sector, and its newly secured electric vehicle contract accelerates growth. So this is a company that's getting things done and things done now. So listen to this. This was just announced on September 22nd. Shapeway Enterprise Manufacturing Solutions signed a contract for over $250,000, reinforcing the company's continued expansion and dedicated strategy in the automotive and EV industry, which we all know is massive and is only going to grow, and we've got some more data here to prove it. Because listen to this, data from Market Markets research projects the electrical vehicle market will reach $951 billion by 2030. And just imagine how much market share Shapeways potentially could take of that. With the commercial EV sector seeing a 22.5% CAGR from 2023 to 2030. This trajectory indicates a major shift toward electric vehicles, with Shapeways playing a role in manufacturing critical components for commercial large-scale electric delivery vehicles. From drawing recent momentum and securing contracts from Tier 1 automotive suppliers, Shapeways has demonstrated the ability to combine enterprise-level manufacturing with high-precision, traditional, and additive manufacturing technologies. This range of capabilities appeals to manufacturers in automotive as well as medical, robotics, and other applications. Now again, why is this so big? Well, this recent contract adds another layer to the company's strong presence in the EV market, which is only going to boom. The demand for Shapeways manufacturing solutions in applications like batteries for large electric vehicles will continue to grow, solidifying the company's role in this rapidly expanding market. So again, everyone, Shapeways, that stock ticker SHPW, is not just about financial gain, it's about being part of a transformative journey in manufacturing. With their innovative approach, proven track record, and strong leadership, Shapeways is poised for success, and you can be part of this exciting journey. But everyone, just quick disclaimer, past performance is no indicator of future performance. All investments involve risk. Do your own due diligence and speak to your own personalized financial advisor. Now, back to the video. So, okay, now to the people that are in this terrible situation with this record credit card debt, what exactly can you do? Well, first thing, you need to create a budget and figure out exactly how much disposable income you have, and don't go out there and buy anything you don't need until you pay that debt off. Now you need to prioritize high interest debt. Look what credit card has the highest interest payment and start attacking that credit card first. Another option, you can consolidate your debt. If you can figure out a way to get 0% financing, if you consolidate your debt, that's an option as well. Or you can do the snowball effect where you figure out what our credit card has the least amount owing, pay that off, and then whatever payment you're using to pay that credit card, then go ahead and chuck it onto the next credit card until you use that snowball method to start doing higher monthly payments until all your debt is gone. Because everyone, like I said, tough times are going to be coming, so you need to have no debt. You need to have 3 to 6 months emergency fund. And then once you've done that, you can start investing, start putting cash aside, because there will be huge opportunities coming out over the next 6 to 12 months. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.